So welcome everybody who's in here. I'd just like to say right off the start, we're going to have kind of an open forum for questions at the end. We'll try to save them for the end if possible. I know a lot of them are going to be very specific, but we will allocate some time. So just wanted to go over kind of the basically just a tax update for this year. The majority of you might already have PRECs, so it's going to make 2020 a very weird year, not necessarily bad, and then going forward in 2021, how things will actually look a little different for your personal taxes. So that's just what we're going to kind of go over right off the hop. I just wanted Daniel to provide a update on any of the little background stuff for the PRECs, the registrations, and a couple of the other legal requirements that you should be aware of when you do own a corporation. So for those that don't have PRECs, not something bad if you're thinking about getting one, and Dan will be able to go into that a little bit more. Look at how the 2020 tax times might change for people, and just right off the bat, so far we have heard nothing about extensions for this year, so everybody assuming like last year we got till September 30th. So far that's not happening, and we don't expect it to. I'll also touch on a little bit what it means for your personal income when you have a PREC, because obviously we're going to try and keep that as low as possible, and how that would work with, if you're looking for financing to acquire a new property or something like that. Just touch on expenses like we kind of do most years for how to make sure you're getting the most out of your tax deductions. Quick little look on the actual rates, and then how to make our lives easier. I'm assuming most of you actually go through an accountant, so just a couple little things from our perspective to kind of make things easier for their lives and ultimately yours, hopefully by reducing costs and things like that. And then I'll touch on just kind of how the CRA audit process goes. It's not overly scary, it's not the IRS, but we'll touch on that and then basically just get into some questions for anybody who would like. So I'll just hand it off over to Daniel here, who's the owner and partner of Think Green Law. They're basically we call it our sister company. They're part of the C&B group. But he came from a downtown firm, and we're really happy to have him with us. So I'll pass it on to Daniel.
He says sister company, but it could be brother company. It's androgynous. We don't take gender positions. So yeah, I mean, we've done this presentation for your group before. I didn't know John and Cheryl. We set up a PREC for them. I'm not sure who else is on here. So I know your team are familiar with them. Yeah, we're just going through some of the list, and a couple of the names do ring a bell and seem familiar. We've done piles of these at this point, and I guess the biggest, most of this session is going to be tax related, but the biggest thing from a PREC component and reason why we thought it'd be good for me to jump in here and just throw some information out there as a reminder that this is a very efficient structure for your financial purposes, but also that setting these up and operating these from a legal standpoint really isn't just as simple as other corporations are. And we've already, not only have we got to doing dozens, if not, I'm sure we're over 100 of these things already. We've also started having to fix them and repair PRECs that were set up improperly by lawyers and by accountants. And so immediately your thought is, okay, if I've paid an accountant or a lawyer to set a corporation up for me, and now I'm having to have another lawyer do amendments and fix those, obviously you're wasting money. But you also, the bigger concern there, we can make amendments to corporations that are improperly set up and fix those. The bigger problem is if you're not operating within the scope that's defined by RICO. So it really is, I guess the general statement is we don't need to go through do these make sense for you? If you're a profitable agent, these make sense for you. The whole structure is to allow you to defer tax. So it ends up being net money in your pocket. From a legal standpoint, there's a few things, and you'll see them on your screen right now, that in terms of how we have to set them up. But the biggest and most important thing is knowing that there are legal requirements for corporations, and these precs in particular have specific obligations. And you need to make sure that if it's not us that's setting you up and managing your corporation with you on an ongoing basis, that whoever it is really knows what they're doing. There's, under the Ontario Business Corporations Act, there's ongoing obligations. If you want to transact business through your prec, whether it's owning real estate, for example, because you're going to speculate and have investment properties, or whether you want to set up a separate company and you can loan money from your prec to your separate company, there are certain specific things and requirements under your corporation that we need to have set up for you and make sure that we're monitoring on an ongoing basis, including every year, annually. There are certain resolutions that have to be completed.
All right, and if anybody's unsure, please feel free. We can definitely review things and tell you pretty quickly whether something needs to be changed.
Yeah, and I mean, we can go through it, but I'm sure you've been through 10, if not more, presentations already about the benefits of precs. So I don't want to bother wasting your time going through all of that stuff. If you make money as an agent, precs make sense and you should get one done. If you don't want to spend a little bit of money to get them done, you're kind of thinking a little bit too short. These will allow you to save a lot of money long term by deferring taxes. So,
Yep.
And then from a legal perspective, there are certain things that you got to keep in mind and make sure whoever's setting it up for you knows what they're doing.
Perfect. And just the last note on that, the biggest thing with the precs versus management companies, sub brokerage, all those special things before, is the threshold is completely lowered now for people to benefit. There was sort of a GCI almost requirement and an amount that you didn't spend in a year before you could really benefit. The precs have dropped that threshold dramatically. So if you thought you might not be able to benefit, definitely give us a shout and we'll be able to let you know pretty quickly.
And there's additional benefits too, other than, so basically our threshold that we've talked about in the past in terms of who needs one. Basically, if you're someone who's profitable to the extent of $10,000 a year or more that you're saving, these make sense right off the hop. And then in other circumstances as well. But these can also make sense for you, not just as an agent that's profitable, but also if you want to be setting yourself up for retirement, because there's certain issues with wills and estates that can allow you to defer taxes and avoid taxes with secondary wills, those kind of things, avoid probate fees by using a corporation. So essentially, if you're a profitable agent and you have questions, give us a call and we'll run through it with you.
Awesome. Okay, so we'll move on just to a little more of the tax side, but at the end, I'll definitely be here to help answer any legal questions. So let's move on to, well, before I made sure that they sent everybody seatbelts. So please look on your left and right and buckle them in, because I know you're all have been waiting for this exciting time. The personal tax deadlines this year, as I kind of mentioned right off the hop, we don't expect the government to extend any deadlines. It doesn't say they might not, but just given the fact that we've had a full year with COVID and they're going to need some money to pay for all these programs they're giving out, we just don't expect them to change it. So don't bank on that this year. Personal tax deadlines really haven't changed for all of you. For most of 2020, you were all self-employed. So June 15th is still the filing deadline. But if you have any taxes owing, they're going to start charging you interest as of April 30th. So if you don't have enough installments on file, if you just had taxes owing, even though you filed on June 15th, they will charge you interest from there. So if you're worried that your installments will not cover your balance owing, you might want to make a payment before April 30th and connect with your accountants. Now, for corporations, those with precs, and sorry, that goes the same for HST. HST is due June 15th. The interest there is a little more irrelevant, but it relates to the installments you might have to do for HST. Now, the corporation, for those with precs, it really depends on when you selected your year end. I know many of you decided on December 31st, but there's going to be some in June, September, whatever the case may be. You have 6 months to file after that year end. That's the late filing penalty. Now, similar to the personal taxes, they actually start charging you interest 3 months after your year end. So if you're a December year end, you're going to want to think about at least making sure you have enough money prepaid, your installments on file before March 31st. If not, it's not, interest isn't the worst of things. I mean, it's 6% compounded basically daily on a yearly basis. So it ends up being closer to about 7%. But I mean, a month or two at 7% isn't going to destroy you. So, you know, if you're going to have to borrow money to pay that off, if you're borrowing at higher than 7%, don't do it. But obviously, if you can, you know, borrow at 3%, you might as well pay it and you'll save a little bit of money. Now, HST, though, this is the big problem with the corporations. You might still think I have 6 months to file my PREC, but HST is still due 3 months after if you file annually. So it's very important to think about your deadline being 3 months after your year end and don't bank on that 6 months. And then the other important deadline is if you're paying yourself from your PREC, which we'll get into more so in 2021. So it's not as important for this year, but let's just say you may have, if your PREC was set up early enough, all those tax slips that have to be filed with the government need to be done by the end of February. So that doesn't necessarily have to be done when you're doing your corporate taxes, but again, it's just another deadline to have in mind there.
Your personal income taxes, you mean?
Yeah.
Yeah. Right. Okay.
Yeah. And the installments, just because you have a corporation doesn't mean you're going to be exempt from installments. Personal tax wise, pretty much most of you are going to be on installment plans. If you're profitable, for the most part, you have to pay the government early. If you don't, they actually will charge you interest based on what you were supposed to pay during the year, based on when those installments were done. So you can't just ignore those. But what some people decide to do is, if they're savers and they can trust they won't spend that money, and they decide they can invest that over the year at a greater return than 6-7%. Now, some people decide to do that and take a little risk there, earn a little bit more income instead of giving it to the government early. If you don't pay installments, it doesn't mean that the government's really going to call you up. Like, it doesn't go to collections or anything like that. So you don't have to be worried about being harassed. You'll get letters to say, hey, we noticed you haven't paid your installments, but they're not going to freeze your bank accounts or anything like that. So installments are sort of discretional, but I still would suggest paying them, especially as real estate agents. End of the year, the tax balance owing can be quite high since you don't have income taxes being withheld on your paychecks. So just be aware, and you can always check in on your installments midway through the year. For corporations, it doesn't really change. You're still going to have to be required every year to make installments. If you don't, they will charge you interest. So once we file, 2020's corporate tax returns, we'd be able to give you that number, that installment schedule. 2021 for the corporations are likely going to be fine if you haven't really made much money in 2020, because they base the installments sort of on what you made in the prior year. So if you weren't really active in your PREC this year or in 2020, you don't have to worry about installments for this year.
And I can just add to that, because we are a sister company of CMB at Think Green. It's really helpful working with, making sure that your money people, your accountants, work with you and are active in their correspondence and communications with you. So one of the things that I really love working with CMB is they take care of my finances. And it really is important to make your installment payments on time so that you don't pay penalties and interest and that kind of thing. But make sure, whether you're with CMB or whoever you're with, that they're open with you and that communication is there. It's really nice working with CMB from my perspective, because I get a reminder. Yeah. And there's good open communication, and that's worth a lot. So just. You don't want to be letting these things slip when it's with CRA. You let one slip, you let two slip, and then you're on their radar, and you want to stay off that as much as possible.
Right. We really like to preach proactiveness and not reactiveness, because especially with taxes, you're kind of already in trouble at that point. And it's much more difficult and stressful when you're in the midst of an audit to try and go back to 2 years ago information and things weren't done accurately and properly, it's even more difficult. But I'll touch on that a little bit further along. So this might be a odd year for some of you, those that have a PREC in 2020. If you were actually earning income in that PREC, this year's taxes will be a little bit different because you're going to be reporting a portion of your year as a sole proprietor. So let's just say your PREC was set up in November 1st. Your January to October 31st income is still going to be like you always were doing on your personal taxes. You're going to report, you're going to get a T4A slip from the brokerages that will be to you personally. You'll still have to pay your HST personally, and then you might get a second one for your corporation. So this year will be the only year I would say where you're going to have both. You're going to be self-employed and also have this corporation. Because the goal next year is that all of your income is going in the corporation. You will no longer be deemed as self-employed because all of your activities and business is in that corporation. So what that also means is you will no longer have that wonderful June 15th deadline for your personal taxes if you have a PREC, because if you're no longer considered a sole proprietor, that's why you had that June 15th date, is they gave self-employed individuals a longer time to file. So you have to be aware of that in 2021, if you're fully using your PREC, April 30th is your due date for personal taxes. And then one little tip for this year, if you do have a PREC that was incorporated in 2020 and has income in it, we're still telling most of the agents to claim all of their personal expenses, all of their expenses relating to, generating their income, claim them all on your sole proprietorship, even up to December 31st, 2020, just because that's where the majority of your income is going to be. It's still going to be on your personal return, and you might be paying very high rate tax on that. So we want to bring that number down as much as we can this year. And it's kind of a one-time deal because of the transition. So that's what we're suggesting is claim everything on your sole proprietorship up till the end of the year, and then Jan 1, 2021, everything goes in the PREC. And as I said, it'll just be relevant for this year. Now, I wanted to touch on as well, we've had this discussion with a lot of people. Real estate agents love to buy real estate as investments. Now, you need to be not accredited, sorry. My words right now are leaving me. You need to be approved for mortgages or potential financing, right? If you don't have the complete cost of the properties in cash, which most don't. And what do they base your financing off of? Your personal income most of the time. Now with these PRECs, our goal is to show as little personal income as we can. If you don't have to spend it, we keep it in the company to save and to defer tax. But that means, you might have went from 200 grand of income on your personal tax return to just 50 this year. We've had conversations with mortgage brokers. I've done presentations with them. They shouldn't have any issues with this. You just need to let them know, again, be communicative. Let them know now that this is how you're doing business going forward. You now have a corporation. Your personal income is discretionary. You can decide what to pay yourself depending on how much you took out. Everything that you did actually take out from the company will declare as income, but everything else, you can choose to take it out or not. So that's what we have to make them understand, is you have to take into consideration the corporation now, the equity that's built up in there, because at any time you're technically eligible to take that out. So if there's ever any issues with, your banks, mortgage brokers, or anything like that, send them to your accountant. If we're your accountant, send them my way. We can explain that to them, but this isn't something brand new. People have had corporations for a long time. They should be able to help you out here. And if they can't, and they're really giving you a hard time, it might be time to look for a new bank.
They're really familiar with this kind of thing. My income goes through my professional corporation, and it's all discretionary as well. And so they've dealt with personal corporations and professional corporations for years. It's just now that real estate agents are finally able to take advantage of your professional status. Yeah,
but just make sure to have a chat with them earlier rather than later, just in case they have some sort of new guidelines from their banks or from their brokers. But okay. So I guess the most important part here is expenses. And everybody always has questions. What can I deduct? What can I deduct? For the most part, what we usually tell people is what can happen ultimately if you get audited and they deny everything, you can end up in tax court. In tax court, you basically have to convince a third-party individual that this expense helped you earn your income. That's really the ultimate test on whether or not it's legitimate. Now, there are some things they just instantly will always deny. There's a reason why they only give you 50% of meals and entertainment. It's just so difficult to prove. But things I know, clothing, suits, haircuts, getting your nails done, all that stuff, they'll instantly just deny. Even though you could realistically argue that, I have I sell $1 million home. Well, every house is worth $1 million now. I sell multi-million-dollar homes. I have an appearance to uphold, right? But they still are just very, very adamant that they will deny those. So generally, we have a list I can send out. If you did want to email me afterwards, and it will be provided, I can send you an Excel spreadsheet that will list off a bunch of general expenses if you weren't aware. But it's everything from meals and entertainment, your vehicle, home office we want to get into as well, your real estate dues, your listing fees, anything you had to spend for your open houses. If you were providing food at the open house, you bought a Bose speaker to play music, you use that at every open house that you go to. It's believable in that sense. So definitely hit me up if you'd like me to send you that spreadsheet. The other thing I would suggest is if you're not sure, let your accountant decide. Leave a note on it, indicate on the invoice or on a summary that you provide saying, I wasn't sure about this expense. They can go over it and decide. But you never want to not include something because you think it might not be deductible. Another thing that's very relevant to real estate agents, again, I kind of have it there, customer gifts and draws. I get that a lot because legitimately real estate agents give back a lot to their clients, whether it's cash back, gift cards, whatever the case may be. Some buy very specific gifts, some buy furniture for people. It's all actually legitimate. And CRA has gotten a little better at understanding that. You just have to really be careful, think about it from a sense on, are you a high volume dealer or are you more a high price dealer? So if you have tons and tons and tons of volume and smaller closings, you can't really argue that you're buying $1,000 gifts for clients and things like that because it's eating away at most of the income you're making. But if you're making 10 grand in commission off of one deal, it's not unreasonable to believe that you gave 1,000 of that, back to your client, back to your customer. 5,000, that's a little different there. So you just have to watch out in that sense. Don't ever be afraid if you actually did spend something and gave it to somebody to claim it, just because you might not think it's deductible. I know a lot of you will sometimes do draws at open houses and things like that. It's very difficult for CRA to prove that this TV you bought and gave away, you really gave away. So just think about your business. Again, if you're trying to run through renovations on your basement as an expense, it's going to be fairly obvious if they look into it, because why is a real estate agent buying lumber and deducting that? Like it doesn't make sense to go that route. So just be a little careful, but you can be a little aggressive in those areas. Just don't be too aggressive. Now, vehicle and home office expenses, I just wanted to touch on those because how we deduct those, and this will sort of be the same for the corporations and the precs, is a lot of them are they're prorated. So make sure you're calculating your totals for the entire year. That's gas, insurance, repairs and maintenance, your finance payments if you finance, or your lease payments if you lease. Just make sure to keep track for the entire year, and make sure you're also keeping an automobile log. And I love saying this because so many people don't, but there's wonderful new apps these days that you can just download for free that'll just start tracking your kilometers. It's good to get in the habit. I know it's a pain, but that's the worst part of any audit, is if they request your vehicle log. It's painful to try and recreate one after the fact. It's possible, but I would highly suggest just trying to keep a vehicle log, i.e. this day I went to this property to go do a showing, I drove from my house. As long as you have the information written down, you'll be able to go and Google Maps the kilometers after the fact, but make sure you're just trying to keep that. And to that note, I've got receipts in capitals there with many exclamation points. I know it's painful, it's very difficult, but once you get in the habit of it, keep your receipts, your invoices. You have to. It's kind of your only defense if CRA wants to review anything. You have to have those receipts, or they're just going to deny it. That's the problem with the government, is they don't use logic. They just go by what their document says that can be allowed or not. They are allowing electronic receipts, so if you want to scan them and keep them on the computer, no problem. They just make sure they're legible. Credit card statements are not enough. They will not accept those as an accurate receipt because they don't know what was spent. I mean, you could have, sure, $50 at Shell or something like that, but who knows, you might have went in there and bought cigarettes or lottery tickets. So that's why they may just always deny credit card statements. So make sure you're keeping the receipts as well and don't just bank on them.
And if I can throw in, I know that your accountants really prefer if you bring your receipts in like a big bag or in a shoebox or something like that. So the more scattered you can be with them, the better.
I love spending my time adding receipts. And speaking of, COVID reasons too, especially this year, I prefer not to receive bags of receipts from people, but it's happened. If that's something you're willing and want to pay for, by all means, we've got people here that will count up all your receipts, but just know it's going to cost you more money. And then we might also be a lot more, not judgmental, but we might have a couple more questions on certain expenses you're trying to run through. Now, if you have a PREC, there are some little differences. For the most part, all of the same expenses are deductible. Nothing really changes from that perspective. I mean, they're just now going to be paid out of your PREC instead of you personally. The only thing that sort of differs might be those vehicle expenses and those home office expenses. What you can do if you do have a PREC, you can put all of your vehicle expenses, 100% of them through as a business expense. If you do that though, at the end of the year, we're still going to have to give you an auto benefit. So this is something a little bit different. On your personal taxes, you're used to just reporting your business portion of your vehicle use. The corporation has a couple different ways, but sort of the easiest is just write everything through. All your vehicle expenses go through the corporation. If you can have it in the PREC's name, even better. And at the end of the year, we'll ask you a couple questions, how much you drove during the year, how much was business related. And based on the vehicle you own, so the more expensive the vehicle, the more this benefit might be, you'll get an actual T4 with an automobile benefit. And it can range from, depending on how much you use it personally. Real estate agents, thankfully, it's not difficult to argue you're over 80% business use for your vehicles. But somebody who only uses it for 50% might get tagged with a lot of extra income at the end of the year. And the reason being, the company got to deduct 100% of the expenses, but you, as a shareholder, as an owner of the company, you got to use that to your benefit. You might have used it 15% of the time for your own personal stuff. That's what that T4 auto benefit is representing. It's basically saying, okay, my company got to deduct 100% of my expenses, but here's the portion realistically that I used for my own personal gain during the year. So you'll actually have that number added to your income on your personal taxes. It's a lot easier to manage that way. It just gets done at the end of the year again, and you don't have to worry about it. You just get to expense everything in your company. Home office, a little bit similar. It's based on square footage, technically, of what your home office room is in your entire house. I mean, most people just end up putting 10 to 20%. It's almost never looked at because it's not worth CRA's time to go and audit that. The home office claims, it's nice to be able to get a pretty, to deduct 20% of your home office. But if you drill that down, 20% of, let's even just say 15 grand or 10,000 to make it easy is $2,000. You'll get $2,000 of an expense, which at your tax rate might be 40%, 50%. So you're only really saving $1,000. That's great, but if CRA sends somebody to go to your house and ask you a bunch of questions, it might cost them more money to pay the auditor than they're going to get back. So that's why they tend to just kind of leave it. So it's not illegitimate or anything like that. This is a completely eligible deduction, but just make sure to keep track of your total household expenses, utilities, repairs and maintenance, property tax, mortgage interest only, or if you rent, just give us your rent amounts. And then just provide us with that breakdown. About 15% of my house is used for business. Okay. So I'm going to keep going. This is just the actual tax rates for 2020. I do have 2021 up there, but they're basically not changing in 2021. There's a little difference between the brackets here, but otherwise the rates are almost the same. So I'll be able to send this to anybody too as well. But what I want you to kind of focus on is this, this other income. All right. This other income balance near the top left, that's basically the personal tax rate. And those brackets you'll see on the far left, those are the tax brackets. Now, I don't know why they decided to have one for $4,000, like 44 to 48. Ontario, I don't know why they made it so complicated, but the tax bracket system is not because you make over 220 all the way at the bottom. It doesn't mean all your income's taxed at 53%. You still get the tax rates for the income on the way up there. So it's sort of like a bucket system. You're still going to pay 20% in your first 44 grand. But as you move into the other brackets, anything above 220, you'll pay 53% on that. So it doesn't just mean, a lot of people want to try and get to the tax bracket below them because it's going to save them a bunch of money. It doesn't really work that way. It doesn't mean all your income all of a sudden is now taxed at that rate. So just keep that in mind. The other important tax rate here is also the capital gains rate. And this is for personal sales. So if you have rental properties and you're selling real estate, capital gains, only 50% of the gain is added to your income. That's why it's half as much as the regular corporate tax rates. You'll see it's almost exactly half going on the way down. So 10% all the way at the top versus 20%. That's the reason being, is only 50% of that gain is included in your income. And that's kind of all I wanted to touch on there. There is something to look at for the dividends, but that's a little bit of a different conversation we'll get into. It's more relevant for 2021 for those with PRECs. We can talk about dividends versus salary and what's more beneficial to pay yourself, but that's something we can do after hours and maybe in a different session because it's not as relevant for 2020. So what makes our lives easier coming from you guys? Just to know, we can access all of your tax slips online. If the government has a copy and received it, we can access it. So if you're worried you might have missed one, don't worry too much. We download everything from the government always just to double check. Summaries will save us a lot of time and you a lot of money potentially. You can, like Daniel say, drop off a garbage bag full of receipts. We have people that do that, but our time adding those receipts, we're going to be billing to you. And sometimes your time, if your time's more valuable than that, feel free. But the most efficient thing is if you can provide us with a summary. That Excel I spoke earlier about the expenses, that's a perfect summary if you can just give us the totals. We don't need all of your receipts. You don't have to give me them all on top of a summary. Just know that you have to keep them. And so it's up to 7 years you do have to keep them for. But just a summary is all we need and will save everybody a lot of headaches. If you do own rental properties, same idea. If you can just a one-page summarize, here's how much rent I earned, here are my expenses for the year. Again, repairs and maintenance fees, property tax, mortgage interest, utilities. Give us the totals, and it just makes it so much easier. A lot of people don't like getting their taxes in early because tax time is normally bad, especially for real estate agents, given you have to pay everything at the end of the year. it makes no difference. Like, just because you file early doesn't mean collections might come after you earlier. It's irrelevant. So filing early is just always better, because if you drop your stuff off on April 20th, we're already, in such a rush. We'll get it done, but there's a lot more attention that may be had when we're doing it a little bit earlier. So sometimes it's worth getting in early. You can have a lot more discussion time with the accountants and a lot more time for question and answers. So I would suggest that if you're thinking of delaying.
I would say the same thing with any of you who don't have PREC set up right now.
Right.
Every single week I get a call saying, oh, I have X amount of closings and I haven't set up a PREC yet. Can you do this for me? And we have to jump through hoops to get it done for you very quickly. If you're going to make money, then get it done now.
All right. So CRA audits. They've definitely gone up over the past 3 years, 4 years, especially Ontario. We keep spending money on Canada. So the level of audits have gone up. Now, how strict they are has definitely gone down. The actual level of the auditors has taken a drop because they've had to hire so many more. It really varies on almost who you end up getting. There's times I've sent stuff that I know is wrong. They should deny this, but they let it go. So you don't have to worry too much, even if you are reviewed by CRA. Again, it's not the IRS. They're not going to instantly just come in and send you to jail. There is a lot of steps you have to go through to get to the point of them freezing your bank accounts. What you'll get a lot happening now versus the major full-blown audits is little tiny reviews, little mini audits. And they're just using their computers to send out letters to just a bunch of people every year now. So that's what we're seeing a lot more now is, last year I think it was professional fees. They kind of just ran an algorithm that said, anybody who claimed this on their business expenses, we want them to prove it all just for that account this year. So just make sure you're keeping your receipts. That's the most important thing. If CRA does contact you and you do have accountants authorized on your behalf, the accountants can speak to them. If you're not comfortable, you can send them to your accountant's way and they can talk to them and resolve everything that needs to be resolved. We also offer, it's called audit insurance. It's not really for our benefit to make money or anything like that. It's really just to be able to cover our costs because all audits are different. It costs in the area of $200 to $500 a year, depending on how big you are and how many corporations you have. But this audit insurance, it's called Audit Shield, through our firm. If you get any review from CRA for that year, we'll take care of it, and you're not getting any additional invoices or bills. So this audit insurance is quite beneficial. Again, it's like any other insurance. You might think, oh, well, what if I don't use it? Well, yeah, you pay for car insurance it's required, but all it takes is one accident. All it takes is one CRA audit, and you could be in the $1,000 ranges for us to actually help you out with that. So if you do want any more details on that, again, feel free to contact us, but it's a pretty decent investment, especially in today's day. And given all of the COVID relief that CRA has been given, again, they're going to need money. The government and CRA are going to look to increase audits again. So definitely inquire with us if that's something you're interested in. All right, just a quick note on registered investments. This is something that comes up most years. And I know a lot of agents, should I look to make RRSPs and TFSAs? Everybody's doing that these days. So just a quick note on that. TFSAs, you're not saving any money. Like if you contribute in your TFSA, you're not getting a deduction on your taxes this year or anything like that. They just don't affect your taxes. TFSA, all you need to know about, whatever money you make, you don't pay tax on it. That's it, that's all. It doesn't matter when you take it out, RRSPs, you can't just put money in and take it out. There's some problems that can occur. So TFSAs, those are a great investment vehicle. And if you're, looking to max something out first, I would look into that just because you can invest however you'd like within it. You can go aggressive, you can go very secure, risk-free, but just know that anything you're earning, you don't owe any tax. The only downside to that is, you might hear that and go, well, I'm gonna do all of my risky stocks in my TFSA because it might go 10x and I won't pay any tax. The only problem with the TFSAs is if you lose money, you cannot claim those losses. So that's the double-edged sword. You want to go risky because you want to make a lot of money and not pay tax, but if you lose money, you can't claim those losses.
And just to be clear, no one on this side of the presentation is suggesting that you invest money in anything that Wall Street bets.
Yeah.
Just put that caveat right there.
Yeah, that train has sailed. So yeah, no AMC, no GME. Forget those. So RRSPs, this will actually almost become not irrelevant for those with precs, but the precs are going to act in a similar manner. So how RRSPs work, the year you make the RRSP contribution, it comes off of your income. So if you made $100,000 this year, you made a $20,000 RRSP contribution, you're being taxed only on $80,000. Eventually, when you take that money out, you're going to assume you're making less money when you retire. If you're not, that's great. We'll deal with that down the road. But generally, most people when they retire are making less money than they were when they were completely active. So when you withdraw your RRSP, it adds into your income. So the whole idea here is we're deferring tax. We're saving tax now. We're going to pay it later. And we get to use sort of that money, those savings now. The other idea is there is a potential tax benefit between the year you made the contribution. You might have been at that highest tax rate, 53%. When you retire, you might only be in that 30% tax rate. So you got to deduct 50% of that and only had to include 30% of it. So there's an actual tax savings there as well. The only issue with RRSPs, if you do have a PREC, if you're not paying yourself a T4 as an employee, you're not going to generate any more RRSP room. So that's why I'm saying it might not even become relevant for you, depending on how we're going to pay yourself out of your PREC. You might not even be generating any room anymore. But that's not necessarily a terrible thing because the PREC sort of acts like an RRSP. The idea is whatever you don't need to spend in your personal life in the PREC, you're saving in the PREC. Why? Because they're for the most part paying 12% corporate tax, much lower than potentially 53% that you pay personally. So we're deferring tax because when you take that out of your corporation, you're going to pay tax on it, just like the RRSP. So the goal is we defer it, we leave it in the corporation, and along the way, whether it's 10, 20 years, there's doors that might open, new opportunities, tax splitting, new rules that the government bring in or change if certain tax rates drop dramatically. So it just gives us time to potentially take advantage of those different tax breaks along the road. And then similar to the RRSPs, when you're retiring, you're going to pull that money out of the company. You might be in a lower tax bracket, so you'll actually pay a little less tax than you would have. And our ESP now is just something else that we might suggest if you do have kids that are looking to go post-secondary education. It's essentially just another sort of tax deferral. You don't get any deductions or anything like that. This is more so just savings for your kids. The good thing is the government actually does match a little bit of it. So up to 20% in a year, up to $500. So if you just want to open an RESP and only contribute up to that maximum, just to get that, I'll say, free government money, that's how you really grow that RESP. Any growth within it, so you're gonna contribute funds to your RESP, and then your advisor or whoever's holding the investment will invest it. And whatever returns they're making, you don't pay tax on it until you withdraw that money. Now, the important thing is, your child has to go to post-secondary education. If they don't, you'll end up having to pay back all of that government top-up, and you're going to pay tax on the monies because you're going to have to withdraw it. If they do go to post-secondary, the money will be paid to them once they reach that stage, and then it's going to be taxed in the child's hands. Whatever above and beyond that the account has generated will be taxed in their hands. That's not necessarily a bad thing because kids in school get really great, university credits that reduce their taxes. So for the most part, they're not going to owe any money on that RESP payment they receive. So that's just another option. If you do have kids that are getting to that age, you can look at contributing to. All right, so that's sort of the end. We're going to get to the questions because I know there's definitely going to be some. This was just a general overview. If you would like to continue this after the presentation, we'll have our emails and contact information available, and please feel free to get in touch with us. Our office is in Newmarket. It's right off the 404. It's not that far from, downtown Toronto even, but given today anyway with COVID, we're very proficient and efficient at working electronically, whether it's personal taxes or corporate. We've done it all this year and last year over the computer, so no problem whatsoever. And without COVID, even if you're further away from Newmarket, we're still willing to drive down there and meet. It's definitely still important to have those face-to-face meetings, so it's not an issue for us to head down there. And this is just an additional part of the C&B group. So we did mention Daniel over here from Think Green, but this is just the other group of companies, sister, brother, whatever we mentioned, companies that we have as part of our group. We are trying to make this a one-stop shop for all of your professional needs, essentially. So we do have an HR company, an IT company, a bookkeeping and business solutions company, as well as Leahorn Capital, which is a mortgage, part mortgage investment company and secondary market investment company, and then also Daniel here with the corporate law side. So if you do need any help with any of that, please feel free to contact us.
And I will just add in, not just corporate law, we do a lot of real estate as well.
Yeah.
So one of the things, it's just a helpful thing. And I had a call last night with an agent who had a really complicated life estate cottage issue up north. We do real estate and corporate law. So if you have questions from time to time, just feel free, just shoot me a shot. And I'm always happy to have just a quick chat with you too, because it comes up often for real estate agents. We have this unique little wrinkle. What should I put in my offer? Or how should we deal with it? Just let me know and we'll get you through that.
All right. And the other benefit of having us all work together is the synergies between us. It's when we're working on somewhat accounting and legal matters, we're always calling Daniel just to kind of give his 2 cents, his suggestions on how we should formulate it most efficiently from a legal perspective, and vice versa on the legal side when they're incorporating companies or suggesting on actual corporate law and real estate law matters. A quick call to our side. Is this also good from an accounting perspective? That's what we're really trying to help here with, or trying to establish here, is complete synergy between all of the different aspects of your business. All right. So just wanted to move on now to questions and answers. So feel free to open up the microphones, and we'll try to take them one at a time, obviously, but
is there a chat function that we can get to?
Right.
Yeah, there is a chat function, and there's a couple of questions in there. Can you see it?
Chat. Perfect. Okay. So I will start near the top here. Here's my email. Oh, so do we need to have receipts if you have credit card statements? I did address that. So yes, you still have to. So if you have the receipt, not the credit card slip, that's also perfect. The receipt is the important part. Now, I have a question here about, we mentioned the home office workspace earlier, and somebody had asked, when you do sell your home, do you have to pay capital gains on that home office space that you're technically renting? The answer is no, because it's such an incidental part of your home. It does not taint your principal residence exemption. So you don't have to worry about that. You don't have to pay tax. If you are renting your basement out to somebody, that's a different story. But if it's just your own home office claim, there's zero worry about that in terms of tainting your capital gains, your principal residence exemption. Can we carry over losses to offset gains in the future? So the answer is yes there. Now, they did also ask with a TFSA. The answer is no. So TFSAs, you cannot claim losses. But let's just say you didn't have, you bought stock in just a regular old non-registered investment account, and you did have losses. You are able, if you can't use them that year, you are able to actually transfer them backwards and forwards to apply against either gains you had in prior year or to continue to carry forward to future years until you have gains to utilize them. So it's always good to still record the losses as long as your accountant's aware, it gets registered and even sent to CRA so they're aware. Right, so again, back to the credit card slip. It is an issue, and if companies are technically required to give you invoices or receipts, some just choose not to. I mean, if it's one or two things here and there, you know, you don't have to really press to go get them, but if it's a pretty large expense, I would sort of press them to get that receipt. The other thing is, as long as they're not a company that might go out of business, you could just risk it and say, okay, I'll keep the credit card statement for now. If I get audited, I will at that point contact the company and ask them to send me a receipt, but you are playing with fire at that point. What if they go out of business, they change systems, they can't get you a receipt? It's just a pain to deal with CRA in that sense. So I just got a question here regarding, should you be aware of setting up investment trading accounts in a PREC? Now, you don't have to worry about that. There's no limitations on that sort of income. You can open up investment accounts, no problem in your PREC. The only thing I would suggest is potentially having a second company, an investment company. The reason being, one, for legal liability purposes. If your PREC gets sued and you have all your investments in there, technically those are up for grabs. If they're sheltered away in a different company, they're a lot safer in that sense. The other reason being, if you're going to get into real estate investments at all, the banks will not lend or give your PREC the residential mortgage rates. Because your PREC isn't a single-use company, because it's doing a bunch of other things, they're not going to give you those rates. So sometimes they require you to have an extra company that is solely there for real estate purposes or investment purposes. Then they'll be willing to actually give you those residential rates or the more beneficial rates. So that's why it is important sometimes to have this investment company. And what you can do with that company is whatever you're making in your PREC, you basically just loan it over, tax-free, no problem, and they get to use that money to invest with.
And a couple of things to add there. If you're investing in real estate, there's significant liability that can potentially accrue. So having it under a separate corporation is smart, because if you're over the course of 5, 10, 15, 20 years deferring taxes through your PREC, and you do end up in a scenario where you're sued by a tenant for slip and fall, or there's some negligence where you just weren't paying attention to something as a landlord, you could be exposing not just what you have in terms of equity in that property, but all of your PREC savings and assets. So it's important from a liability perspective to separate it. Similarly, the specific question was anything we should be aware of setting up a trading account. I don't know whoever that was from Andre. So I don't know, Andre, if you do any shorting or get into options trading and put trades in options. But you can end up in a scenario where theoretically liability is unlimited, right? And so obviously this is a less common scenario, but you could end up with a scenario where you think you're making a trade that's not going to cost you too much, but your loss ends up being substantial, and that would be subject to the funds that are in your PREC and the assets that are in your PREC. So if I was having a trading account, I would set it up in a separate corporation and loan money across tax-free, and I would do the same if I was going to be investing in real estate.
Right.
And to that end, I have a professional corp that operates in a similar way to PRECs, and that's how I set it up. So I can tell you personally that you should segment things from a liability perspective.
Right. Awesome. Okay. And now the next question we have is a PREC still efficient for somebody who has other income or payroll from a full-time job? I would say it might even be more beneficial, because if you can live off of what you're earning in your other job and you don't have to spend any of your real estate income, we can then shelter all of that and only pay 12% tax versus potentially 40, 50% personally. So it might even be a better situation where you get the full benefits of it. You don't have to touch or take out any of your real estate earnings. Even if you're earning only $10,000, $20,000 net, again, you might pay 50% on that and have to shell out 10 grand to the government for that versus only paying 12%. And then you can use that in your prec or another company to invest with. So I would definitely suggest that even if you have another job, it might even be more beneficial. All right, the next question we have is, can you earn other non-realtor income in a PREC? Yes, it's as long as you're not doing any other real estate deals for anyone else, for anyone else, any other agent. You can't hold money for anybody in that sense, but you can earn your income in other ways if you'd like. They don't restrict that. I don't think there's anything.
No trading in real estate.
Right.
And to that end, just a little bit of a warning, because we have seen it a couple times, and I've been trying to catch it for agents when I have deals come in, offers that are accepted that come in. You cannot be advertising advertising your prec as trading in real estate or trading in real estate through your prec. So when you're setting up your offers or accepting offers on your OREA forms, you're not including your agent information as your prec. That's you as the agent that's trading in the real estate. It's your brokerage that's the brokerage. So just keep that in mind, because otherwise you're running afoul of the REBA rules.
Perfect. Very important. Because the worst thing you want to have happen here is somehow your prec 1 year is just deemed ineligible. You're right back to having all that income personally and paying tax up the wazoo. So,
and there's another thing that can happen that makes your prec deemed ineligible, and that's if you're not managing your corporate affairs on a year-to-year basis. Right. If you're not doing your annual filings, we can fix that for corporations, and we do that all the time with omnibus resolutions that are retroactive. But if CRA catches you not doing your proper annual legal filings for your precs, you could be deemed ineligible, and you would owe tax on all of that income. So it's really important not just that you set up your prec properly, but you spend the very little amount annually to make sure that you've got a lawyer doing those resolutions for you. You can do them yourself, but for a few $100, you can make sure that they're done properly and you don't expose yourself to a really, really high amount of potential tax.
Right. And the nice thing is, well, here at our office, that's just done seamlessly. Well, assuming that's what you're asking for, but there's no back and forth, no additional time. The accountant's having to call the lawyers and then they bill you for that as well. So it's very seamless here. And I don't know how many we're holding, but we've got walls of minute books that we're holding for people because they don't trust themselves to keep it safe. That's something that they offer as well on top of the annual updating. It is important to have. You don't want to. That's another thing. You don't want to be reactive in that sense. If stuff hits the fan, you want to make sure your records are up to date and proper. Again, it only matters when things go wrong, but it can ruin you if it goes wrong. So I don't see any other questions at the moment. If anybody has any more, feel free to throw them in there. But otherwise, again, our information is there, and we look forward to following up with anybody if they have any additional questions. But otherwise, have a lovely rest of.
That was very, very thorough, and we really appreciate you coming on to do this for us. It's awesome.
No problem.
Thanks very much, Nick and Dan. Much appreciated.
No problem. Yeah, and it's usually a lot more interactive in person, so we hope to get back to that next year, but it really depends. But this is still great to be able to see everybody and at least answer some questions efficiently.
That was awesome. Thank you again so much. And thanks to everybody who came on.
Okay. So
Thanks,
again,
everyone. Take
our
care.
information's there. Have a great rest of the day.
All right, enjoy the rest of your day.
Thank you.
Bye.